Hey, Eric, can I join you on the couch? Can we do yeah, let's do this. So this session is really capping off day one of our event, and it's meant to be just a casual conversation with Eric Satz. So Eric Satz is the CEO of AltoIRA. Some of you might be familiar because you might use AltoIRA to invest in AcreTrader offerings or other alternatives. Eric started his career in investment banking, and then later went on to found CurrentX that was acquired by Straight Street, and then kind of went on to found another company, Plum Good Foods, before working and thinking through how to democratize alternative investing by opening up retirement funds through self-directed IRA funds. So today's...
I can't even remember all that.
Studied you, man. Today's session is really just to ask you questions about that experience, sort of founding AltoIRA, and also to get your perspective. Given your seat, you have a really unique view into what investors are doing with these funds and how investors are using AltoIRA to access alternatives. So we're excited to have you. It's a fireside chat. I meant to bring a candle of sorts, but I didn't want to get yelled at by the venue, but pretend there's a flame behind us here. So I guess I'll kick it off with my initial question and the obvious question.
Actually, before we get started, so there are two really tough sort of conference slots. One is right after lunch. I refer to that as the coma hour. And the other is right before alcohol, which is this one. And so I'm going to ask everyone to stand up just for 1 second before we start. This is like a networking event, right? So I'm going to ask you to meet two people you don't know and tell them two things, maybe even three things about yourself as to, your name, why you're here, how many flights it took to get to Fayetteville, something like that. And I'm going to do the same. All right.
Hopefully you made a connection that you can continue here shortly. So let's just start a bit with the basics and let Eric kind of speak for himself and speak a bit about his experience. So can you just share a few words about your professional background and really what led you to found Alto, and when officially did you found AltoIRA?
So I think it's like anything else I found, it's a personality disorder. So you kind of get this thing in your head, and you can't help but begin to pull on a string, and you keep pulling. But to put more specifics behind it, back in 2010, and I know Steve Case was here, and Rise of the Rest, I don't know if you all got to see him. Unfortunately, I missed that. But that was really when Rise of the Rest was starting, and I'm from Nashville, Tennessee. And I started a venture fund, and the fund was formed to invest solely in Tennessee-based businesses. And as we began to invest that fund, I began to invest alongside the fund. And I don't know about you all, but I open mail like once a quarter. And I was getting ready to make an investment in one of the portfolio companies, and I had my IRA statement show up. And it was one of those things where like I sort of forgot that it existed. And it was about that time in the quarter. And I opened it up and I had this light bulb moment of this is the money that I should use to invest in this private company. And it made all the sense in the world to me because retirement money is long-term money. So from a duration matching standpoint, putting retirement money into a private company where you're really not expecting to see liquidity for 7 to 12 years made a whole lot of sense. And the other reason you invest in a private company is because you expect an outsized return, the whole risk-reward part of it. And that's important because retirement money is tax advantage. If you're investing out of a Roth IRA, it's tax-free because that money went in after having paid taxes. And if you're investing out of a traditional IRA, SEP IRA, that's tax-deferred, right? And so you get to benefit from what Einstein referred to as the 8th wonder of the world. Compounding interest, compounding returns. And so I thought this was a brilliant idea. And so I called my financial advisor and I said, I'm going to make this next investment out of my retirement account. He said, great. I said, well, I'll send you the wire instructions. He said, no need. And I said, why not? And he said, because you're not going to make that investment with us, through us. It's a big broker-dealer. And I said, why not? I went to Google, I looked it up, this is totally legal. And his response was, yeah, we get it, but our investment committee is never going to approve this company that we never heard of. If you lose your money, you're going to sue us. Long story short, I said, what do I do? He said, I don't know. So I went back to Google and I found the self-directed IRA industry. And I made my first investment. This was back in 2013. And it was a god-awful experience. It took me 10 weeks to do what you do in sort of the checking savings world in 10 minutes. And so I said, well, clearly I picked the wrong custodian. The next investment I made, I chose another custodian. I made a third one with yet a third custodian. Same, if not worse, experience each time. At which point I said, is this a big enough problem to fix? Am I the only person with this problem? Does anybody else care how big an opportunity is? Sort of the questions you ask when you're getting ready to start a company or think you're getting ready to. It turns out there's $30+ trillion sitting in retirement accounts. And what I really didn't know was that the largest bucket of that retirement money is in IRAs, not 401ks. It's a little bit counterintuitive because, sort of as each younger and younger generation has begun to job hop from company to company, they get the opportunity to roll their 401k into an IRA. And then with the gig economy, those people don't have 401ks to begin with, they have IRAs. And so now we have a situation where we've got 13+ trillion sitting in IRA accounts, give or take 8 trillion sitting in 401k accounts, so the rest in pensions. IRAs are growing faster than 401ks. 401ks still growing, by the way. At least they were like 3 months ago or something. But that was the genesis. So I had this idea in 2013. I talked to all these people, people who, general counsels at large companies who were friends of mine. And, it's the typical sort of story you hear all the time. Fidelity can do this, Schwab can do this, E-Trade can do this, Ameritrade can do this. Everybody can do this, but nobody was doing it. And then you talk to, so the original idea, before I knew how IRAs were growing relative to 401ks, the original idea was to do this in 401ks. And so I speak to general counsels and they'd say, NFW. I don't know if no fucking way. So they'd say, no fucking way. I'm like, why? Like, it makes all the sense in the world. If you want portfolio diversification, we're just trying not to get sued. Right? Like, we have a third-party administrator, we have other fiduciaries, we just don't want to get sued in our 401k. Right? And so everybody said, no, don't do it, which for me is like, yes, do it. And so in 2016, I just couldn't help it anymore. And I started to build it, and we launched in 2018. We're in 2022 now, yeah? Okay. 2022. We've got 30,000 clients, 1.2 billion in assets under custody, not management. We're not a fiduciary. We have a wholly owned trust company. We're about to get a broker-dealer's license. We have 80 plus partners, including AcreTrader, and so we're about to start.
I have a quick question stemming off of something you mentioned, and that was really, you just found there was just so much friction, right, when you tried to engage these other custodians. What would you say were the top 2 to 3 friction points with those custodians that you knew you just didn't want to, you really wanted Alto to be different in those regards?
It's like such a perfect question. People and paper.
Okay.
Like people and paper. So this industry hadn't changed since the early 1970s when ERISA was created. Right. And every time I was doing a deal, the custodian would move the goalposts in terms of what information they now needed. And the other thing was, I was doing all the work. You know, I was the execution engine for my investment between me and the company I was investing in and the custodian, and I wrote the custodian a check for all the work I did. It just made no sense to me. I mean, call me old-fashioned.
Well, so presumably, so there's been a whole generation of people who have had really negative experiences with custodians. I assume that there had to be a ton of work that your team did to frankly spread the word that there was this alternative. That was a pun. And you're welcome. What if you had to kind of choose a single inflection point where you really felt that AltoIRA was beginning to really launch and scale after it was founded in 2016? What was that? What special moment stands out to you as being that inflection point for the business?
I actually don't think we've hit it yet. And I say that for a couple of different reasons. So by the way, I had never been to Fayetteville, and I spent kind of the morning walking around, and I absolutely love it here. Like, I spent a bunch of time in Little Rock as part of, I don't know if anyone knows the company FIS, but large banking core provider, but a lot of time at the FIS accelerator, FinTech accelerator in Little Rock. Sorry, I'm old, I forgot the question.
Inflection point.
Yeah, inflection point. Thank you. Yeah, and I'll tell you, so as early as 2017, and certainly a lot in 2018, and then going forward, anybody who would listen, I would say, I would talk about the importance of portfolio diversification and the need to include alternative assets in a portfolio, and that 60-40 is dead. Now that the New York Times and the Wall Street Journal and Forbes and Fortune and everybody else is writing that 60-40 is dead, now it's officially dead, but when I was talking about it, it was like that crazy, the guy with the personality disorder over there, right? Yeah. And while I think people are now talking about it, people are trying to figure out how to embrace that fact and how to actually employ a strategy that embraces portfolio diversification. I talk about portfolio diversification, by the way, because it is a free tool for all of us. It reduces overall volatility, and at least I know there are damn lies in statistics, but statistically anyway, you get higher returns with a diverse portfolio. And so I'll talk about it and talk about it and talk about it. I think we need a couple things to continue to break our way to really hit that inflection point. And those things are regulatory obstacles or hurdles. So Title III, the Jobs Act, regulation, crowdfunding was all a huge win in the right direction. But the idea that The idea that people can go work for startups, but not invest in startups, makes zero sense to me. And so we'll keep working in a direction such that everyone will have the same opportunity to invest in the next big win that any other sort of high net worth, ultra high net worth professional investor is allowed to invest in. Right? The idea, I take great issue with the fact that we need to be protected from ourselves. I don't believe that shit. I think people take their money and investments, and particularly their retirement, very seriously. And so, as we continue to break down those hurdles, I think we'll hit the true inflection point. With respect to Alto and our growth over the last 12 to 18 months, by the way, really refreshing to hear people talk about land and pigs and soybeans, and I've been talking about for like the last 9 months, I've been talking about Bitcoin, Ethereum, Solana, DeFi, like, virtual stuff. I think we will get to that place where everyone actually has the opportunity to invest in A, what they want, and B, what they know. And when that happens, I think we can achieve portfolio diversification.
But to that point on what they know, I think one thing that both our teams share, the AcreTrader team, the AltoIRA team, and we're not formal partners, but we work together so frequently to support users on both platforms that we, I think, share similar challenges. And one of those challenges is educating investors and coaching really investors on really our product. In the case of AcreTrader, it's farmland, it's land as an asset class. For Alto, it's really understanding the power of using retirement funds to invest in alternatives. What would you say when you think about your team and the coaching or the investor education that your team really needs to accomplish when they engage with a client? What are 2 or 3 of the most common misconceptions that you find that you need to correct?
So I'm going to be specific with respect to that question, and then I'll be more general. So a lot of people are concerned that they lose the tax advantage nature of their IRA when they transfer funds from one IRA to an IRA like Alto. In fact, we're a custodian like any, we have a wholly owned trust company. We're a custodian like anybody else. There are no tax consequences, so long as you do it properly, and we hope you do it properly. That's the single biggest educational point. With respect to IRAs, we have a set of core values that people can look at, one of which is educate to drive equality. If you ask me where we are failing with respect to our core values, I think we still fail with respect to educate to drive equality. Education, specifically in alternative assets, is hard. But if I take everybody back to investing in public markets, when Charles Schwab came out, $49.99 a trade was discount. That was cheap. Now they practically pay you to trade. I mean, let's not get into the whole Robinhood thing, but what the brilliance of Schwab, in my opinion, there were actually 2 things. One, he said this needs to be on every corner of Main and Main, and then he said anybody can do this, and we'll help you, we'll teach you, and I feel like that's the role that we need to play in alternative asset investing. We got a long way to go.
Well, I want to kind of turn and rather return to what you were speaking about the kind of death of the 60-40 portfolio and the demise of that way of thinking about investing. And my question is, if you had to reorient the ideal portfolio, how would you slot your percentages?
So I'll talk about the ideal, and then I'll talk about the pragmatic. And I'll also talk about why 60-40 is dead, by the way. The 60-40 is dead because of the rise of ETFs and mutual funds. And nobody picks stocks anymore. And if you look at the public markets, and I'm just going to talk about the equity side for a second, only 400 companies matter. So every mutual fund and every ETF is comprised of some subsegment of those top 400 companies. So I don't care how many mutual funds or ETFs you have. If you have more than 5, you don't get more portfolio diversification, you just get another mutual fund. So in an ideal world, you've got 5% invested across 20 different asset classes. Too hard for just about everybody. Probably 20% invested in 5 asset classes, far more achievable. And I think, at least for me, that's what we would like to see as the next step for people to sort of reach for and attain, which is like, how do I get 20% of my money in 5 different assets? By the way, nothing wrong with public stocks and bonds, just not the be-all, end-all. That's all I'm saying.
And to that point, when you look at sort of user behavior, AltoIRA user behavior, give us a sense of what that behavior looked like, say, in October of 2021. And what is that behavior looking like now in October of 22?
Yeah, so October 21, it was Bitcoin, Ethereum, Solana, Cardano, just like 100 different cryptocurrencies. Like, how do I get rich quick? October 22 is way more thoughtful, way slower, a lot more diligence, and it's across things, it's across real assets, right? So whether it's farmland or multifamily housing, not a lot of early stage private company investing going on right now. It's things that people believe are going to be around for a while.
There's something very reassuring about real assets and the tangibility of real assets, and certainly I know I'm preaching to the choir when I speak about that with farmland, but I know we've heard that as well from a lot of investors. I'd like to just open up the floor for a couple questions. Would anyone like to ask a question? Yes, in the back, and I invite you to project.
Okay, if you have, let's say you have a 401k and say a cash balance plan, and you want to use your product or your account, can you do that, or do you have to like close some of your other retirement accounts to use your tool?
So if it's actually, the answer is really nuanced, so I'm going to try and take an 80-20 rule here, all right? If you have cash in any IRA accounts or other 403B or whatever, ESP, other places where you're free to transfer, you can transfer funds out of those accounts into an Alto account that you've created. You don't have to transfer the whole thing. If you have a 401k and you're still employed, you're stuck until I don't mean to say you're employed. That's great. That, the money in the 401k stays in the 401k until you are no longer employed. Does that make sense?
Yeah. So what I'm hearing you say is I can do that through my cash balance plan. I can move some assets over into an IRA without impacting my 401k.
The 401k, so that's like walled garden, that's by itself. Yeah, I don't know your cash balance plan, so.
Well, we can talk later maybe. Because I'm interested in using, because I just texted my advisor, or emailed my advisor, and he said, yes, we can do a private investment through your cash balance plan, but I don't recommend it because of UBTI and UDFI, whatever that means.
Unrelated business income tax, it all depends on the investment you make. 9 times out of 10 never comes into play.
Right. So if I want to do
But he doesn't want to lose the money. So, I mean, let's just cut to the quick. He wants the money.
Right.
On that answer, by the way. So you said, practically speaking, 20% into 5 different asset classes. What are those asset classes in your mind?
So I can tell you what I like, and I gravitate towards what I know, which may not be what you know. So I do private companies, both early stage and late stage. I do real estate. I do crypto. So I don't do land. Like, I haven't spent the time to understand. I haven't had the time to sort of really dig in and understand.
It begins tonight.
What I'm investing in, right? Like, so I want to do homework when I make an investment. And so for me, it's really those sort of 4 categories.
Okay.
And it's 20 and 5 is hard, right? That's why 5 and 20 is like impossible. But yeah.
Right. Oh, sorry. Let's go. You, sir. You, and then I saw a hand over here, and we'll end with you. Okay.
So so we're in the wealth management space, and kind of along the line of not wanting to lose money. Like, is there a future where we usually recommend AltoIRA, but there'd be like an awesome opportunity for us to be able to click some buttons and just drop money of our clients in directly? Is that?
Yeah. So we want you to have the SMA capability for your clients, 100%. For those who don't know, because I'm dropping some jargon there for these 2 guys, separate managed accounts. So where they have the ability to invest in various asset classes, $10,000 from this person, $10,000 from this person, $10,000 from this person. And as we get to the broker-dealer stage, we'll be able to do the feeder funds with you all. And we're also looking at SMA providers so that we can, I don't know what your back-end system is, but so that we can tie into all of that and you keep a systematic, holistic view of your client's assets.
Sweet.
Here.
What's the wackiest asset class that none of us are thinking about, that you had a client come to you and say something, you guys are running around, I don't know if I can do this. What's the asset class that you guys get asked about that you're like, that they made you guys work and do homework on it? To either consider offering it or, yeah.
So we don't play judge and jury is the first thing I'll say.
Fair.
We're not a fiduciary in that regard, we're an administrator. What's not okay inside a retirement account is a collectible. And there's long history that goes into that. And so for example, you can't buy a Van Gogh with your retirement account, hang it on your wall and call it an investment. But what you can do is buy a securitized interest in the Van Gogh. And I guess you can hang your, certificate of ownership on your wall and call it an investment. But so we have a platform partner called Masterworks, which enables you to invest in artwork with your IRA. But back in 2017, I knew that I wanted people to invest in crypto out of their retirement account. And so back in 2017, that was pretty fucking wacky.
Yeah, well.
Right? But it turned out better to be lucky than good sometimes, right? Actually, all the time. And that one turned out okay. So you can invest in cows. Obviously you can invest in farmland. You can invest in cows. You can invest in livestock. You can invest in wine. You can't drink it. It's one of those securitized examples again. If it's not publicly traded, we can help you figure it out. We're not going to tell you it's a good idea, though. Yeah.
Right, we have one last question, Mr. Tulare.
Yeah, so I agree that the self-directed IRA is a thing to do with. It's prevented me from putting a lot of money in. What's the difference between what you do and what's called a checkbook IRA? Because they tell me that is much simpler.
So the difference is, well, there are 2 big differences. The first one is that a checkbook IRA is a legal construct where you create a single member limited liability company, and your IRA is the sole member of the LLC. It's called a checkbook IRA because the idea is that LLC has its own bank account. By the way, if anyone doesn't know this, you and your IRA are two legally separate things. And the two are not supposed to mix. Like one cannot benefit from the other until you reach retirement age. So you're the member. Sorry, you're not the member. You're the managing partner of the LLC. Your IRA is the owner of the LLC. And you could just make investments out of the LLC that has this checking account. And that's why it's called Checkbook LLC. The self-directed IRA custodian, from its viewpoint, sees that your IRA has made an investment in a limited liability company. But then you do all these things out of the limited liability company, and your custodian, that trust company, that's supposed to be overseeing this checkbook, is blind to your activities. The most recent ruling, and by the way, it's a bad idea, okay? But the most recent ruling had to do with people who invested in gold through an LLC, and they kept the gold in a safe in their house. And what the courts determined was that having control of the gold outside of the construct of a custodian, and by the way, there are custodians who literally, what they do is hold gold. That was deemed a distribution. And they had to pay taxes on that. So if we roll that forward, every checkbook LLC, and checkbook LLCs, by the way, were a great construct created mostly for real estate investing. Because what do you do when you have to pay the HVAC person? Or the roofer? Or you need new windows, or new lights, or new locks. Like, you don't want to ask your trust company for a check for that every single time. Right? And that was the original purpose for the checkbook LLC. But what I would tell you is that, and so where this became really big, by the way, was crypto. Because people wanted to hold their crypto in their own wallets, and they did it through this checkbook construct. As soon as the IRS and all their new agents actually want to look into this, like, it's a house of cards. So, for my money, I'm not a fiduciary, but what I will tell you is don't do that.
Thank you for all of your questions. We'll be able to continue this conversation. I'll invite Michael up to give us some logistics and excuse us, but everyone join me in thanking Eric. Thank you, Eric.
Thank you all.